Hey fellow traders, let's talk about the math of winning in trading. What is it about maths and trading that go together? Does maths somehow have an effect on your trading? And will it make a difference to how you succeed in the marketplace? Well, over the 30 years that I've been trading, I discovered that there's a simple strategy, a simple method that actually will help you to be successful in the markets, which involves a little bit of maths and a little bit of calculation to ensure your success in the markets, to ensure you become a profitable trader rather than a losing trader. So we're going to talk about that after we've been to the charts, because first what we're going to do, we'll go and have a look at the charts, man. We'll go and see how you can trade support and resistance, because before you can use the maths, you do have to understand a system of high probability trading. Those of you that know me know that I call the market a 50-50 game. In other words, the market is made up of loads of buyers and loads of sellers, and everybody thinks they've got a winning system. Everybody thinks they're the most successful trader on earth. And with that, you get a 50-50 game, because for every trade that you see, there's an opposing view on that trade. Would you believe there's actually an opposing view on every single trade? Guys, trading is risky. 60 to 80% of traders do lose money on a regular basis. So if you don't like losing money, you don't like risk, don't trade. It's as simple as that, guys. Don't bother trading if you don't like losing money. If you want a free Forex book, drop down to the description. I got one there for you. You can simply download it and enjoy it. It's free, doesn't cost you anything. Have some fun with it. At the end of the day, you want to know how you can be a profitable trader. And what we normally do, all of us, is we have a course, we go on a course and we learn all these fancy tricks and all these fancy things, and we go and we buy a system that costs us thousands of dollars, and we take that thousands of dollars system and we run with it, and then we think we're the most profitable trader on earth. We think we're the most successful trader on earth, and we've paid thousands of dollars for this system, and this is now going to make us rich. Well, no, that's not what's going to happen, guys. At the end of the day, the minute you put real money into the market, that's when everything's going to change. That's when everything's actually going to go pear-shaped for you. It's going to turn upside down. You see, the problem is what you do when you go on these courses is you learn all about the squiggly lines, you learn all about the high probability trades, you learn all about the strategies and systems, but what you don't learn is the psychology of trading. What you don't learn is what's going to happen when you actually put real money into the market. What's going to happen to the receptors in your mind, what's going to happen with those fear receptors, what's going to happen to the adrenaline, because everything's going to change. Everything's going to become a completely different picture once you get into the market with some real dosh. So you spent thousands of dollars on a course. You've got a system. You don't need to change the system, but I am going to show you a system that I use, that I've used for many years. Very simple. It's price action. It's support and resistance, and I want you to have a look at that. This is going to help you with your high probability trading. Those of you that know me will know that I always use this system, and many of you have converted yourselves over to using this system because it's simple, it's straightforward. You don't have to wait for the stars to align on the left and the stars to align on the right before you can take a trade. It doesn't get overcomplicated. It doesn't make you insane. It's straightforward. It's easy to understand and easy to learn. It also doesn't involve loads of indicators, loads of lagging indicators. It's simple price action. It's simply looking at where the price is, understanding where the money is, where the orders are lying, and taking your trades based on that. In other words, high probability trades, which is really easy at the end of the day. But that's the easy part. The difficult part is bending your mind around it. And that's what we're going to get to after the charts. And that's where we're going to go. And we're going to show you the maths of trading. We're going to show you why the maths of trading is more important than the probability trade and the squiggly lines that you're going to use for your trading. Let's go to the charts. let's go and have a look at that first, and then let's get on with the maths of trading. How do we trade support and resistance in the markets? Now, this has got really very little to do with the maths of trading. That I'll get to after we've been to the charts. But right now, I'm just going to show you the method that we use to actually trade in the markets to make it easier for you, to make it easier for you to understand the best way to actually trade in the markets. Shall we use... We can use the DAX. The DAX is a good place, but there's a lot of other lines in here which are a little bit irritating, you know, where trades have been made and that sort of thing. Yeah, here's the R50. I suppose we could use that. That'll be quite... Let's remove all the drawings. So you get a chart like this, and the reason I'm not using the DAX is because you can see there's some trades in here which are just going to get in the way, and I don't want those lines in the way. Right, okay. So you get a chart like this. On the 4 hour, this does look very bearish. Looks like it's toppling over down to the downside. But now you want to see what kind of a trade can I take on this index. This is a R50. It could be Forex as well. It could be the Euro, US dollar if you want. Doesn't matter. We trade anything. It all works the same. And it works the same on any time frame. It works the same with absolutely any product. There's nothing complicated about this, guys. Don't worry about all the rubbish that people put into your minds to try and overcomplicate it and help you to lose. I try and help you to win here. So you want some high probability information on this chart. You want to know what's your next move going to be. Now, if you're trading on the 4 hour, what you're going to do is you're going to go to the day. Sometimes I even go to the weekly and I have a look at what's going to happen on the weekly. So let me give you an example of that. We go to the weekly at the beginning of the week and we say, well, what actually happened last week? Let's have a look here. Last week, what actually happened? There's a bit of a hanging man there. Okay. It's in a bit of a range. It's running between 67.11 and 82.53. There's a few red candles going down here. It ended on a hanging candle here. And if I look at this, it's very undecided. So for the week, it's actually very undecided. Bit red, but very undecided. Looks like the buyers tried to come back into the market. So now you've got an idea what's going to happen for the week. But now what we want to do is we want to trade on the lower time frames. The first thing we do is we go to the day chart. Now, why do I take my levels from the day chart? Why do you think that is? Simply because the levels on the higher time frames are more reliable. So on the day chart, I'm picking out reliable levels for my trading, and I'm looking for a support and resistance. Now, I use the candles to trade because I like to see where the green ones and the red ones are. I like to see when a red one's coming out of support, out of resistance, and the green ones coming out of resistance support, so that I can take those trades. Sorry, the red ones come out of resistance, the green ones come out of support, right? Then you can take those trades and you know when to take those trades. Longer candles depict big moves, big amount of selling, a big amount of buying. And if you keep the candles green and red, our brains are wired for green and red, and it just makes it easier for us to identify what's actually happening in the markets. I see a lot of traders changing the color because the red scares them or whatever the case. Guys, if you keep it the way it's supposed to be, it's so much easier to identify what you've got. And if you understand that you're basically trading both ways, does it really matter if it's red or green? Sometimes the red is making you money, so you're happy about it. So stop worrying about what color they are. Start worrying about which way the market's moving. So the best way to get your levels off any chart is to take it to a line chart. And the reason I do this is because the line chart gives me closing prices and the candle chart gives me highs and lows and tails. I don't want highs and lows. I want closing prices. If I look at this chart, what you're looking for is an area at the top and an area at the bottom where price likes to head to, like a magnet. It likes to go there. It likes to end up there because that's where all the orders are. If you see every time it gets there, it bounces off. That means there's lots of liquidity there. And that's where most of the money is, in that area. So what I see here is there's a resistance area and there's a high of the resistance area, one amount where it went through, and that's your resistance. Now, the reason I draw a rectangle is because a straight line is great, but price doesn't go to straight lines. Price doesn't draw lines in the sand. Price goes to an area where there's some money lying. So this is an area where there's some money lying. Now we look at the bottom and we say, where's the area at the bottom where there's some money lying? And it looks like there's an area, this isn't the best chart in the world, but there's an area here. So that'll be your main support area on the daily chart. So this is your daily chart telling you that there's a main resistance of price here where the price likes to hit in the range. And here's a main support area where price likes to hit as well. There's also a trend to the downside, but it's in the range, and that trend is ending on this support as we stand at the moment. So it could bounce off here and go back up. So this is more like in a range than anything else. But the general trend has been to the downside over time. You see it's been coming down, been hanging around in this range. This might resolve to the downside. It might break through this support, come back, retest, and carry on down. So it's not a guarantee that this is going to bounce to the upside. But anyway, what we do then is we take it back to the candles. And what we're looking for on the candles is the red candle comes out of resistance. It means you go short. The green candle comes out of support and gives you a nice green run. You go long because you're staying in this area for now. If it breaks through the support, gives you a red candle out of here, it should come back and retest, give us another red candle, and then we can take the short down. It's as simple as that. There's no complications, but we want to trade this 4-hour chart, not on a day chart. So we go back to the 4-hour. You can do this on any time frame that you want, and then try and make it so that you can see the picture, of course. So now what we've got on the 4-hour chart is this is coming out of the support. There's a lot of buyers. You see that long tail on the red candle? There's a lot of buyers that have come back in here. And there's the buyers continuing on the next 4-hour. Buyers continuing on. That's a bit of an undecided candle. And then we've got a couple of unsure red candles at the top here. But if this comes back a little bit and then gives you a green candle out, you can actually go long. If it breaks through the support, comes out the other side, then you're looking for a short. On the flip side, when they come out of resistance and they give you these long red candles and they close, that gives you the signal to go long. So on this trade right now, because you've got a couple of green candles that have closed outside the support, you could say, I want to go long, but you're taking your trade based on the fact that you're going to put your stop loss just below the support and you'll take profit up here at the top by the resistance. That's how you trade with support and resistance, guys. And that was just any old chart that we're not trading on. We're doing the same on the DAX. I'm looking at, there's a trend that's running down here, and that's a trend resistance. So it's hitting trend resistance. So you would hope that that might go short and go down the other way. So on the France 40, you've got a very similar picture, but you might want to watch out for a trend resistance in the middle of this picture somewhere over there. You're normally looking for 3 touches, and you could have a resistance sitting right in the middle of this picture, just about here at the 74.40. But don't overcomplicate it, guys. If you want to trade with trend, you can trade with trend. This looks more like it's in its range and it wants to trade up towards the resistance at the top here. So look at that scenario rather, and don't overcomplicate it with drawing too many lines or too many things onto your chart and overcomplicating your trading. Like, for example, this gold trade, what we've done here is we've added in a kind of a supply and demand. This is in trend. It's been going down, going down, going down. It's come back, taken some money, and now it looks like it wants to go down again. This is a supply and demand sort of scenario. Okay, so if you want to know a bit more about supply and demand, very similar to support and resistance, go and have a look at my videos which teach you how to trade with supply and demand or fair value gaps, and that'll give you more information. But I don't want to overcomplicate your trading for you in the slightest. Let's try and keep it simple for you guys. Let's not get overcomplicated at the end of the day. These are brand new trades that have just come in, so you're not going to expect much from them just yet. Okay, US 500, very similar picture. It's been going up, came down. This looked like a bit of a pennant, so looking at it maybe breaking down, but it has broken up this morning, so looks like it might want to go long there. FTSE taking a nice long run out of here. As we showed you on the France 40 now, you see the green candle came out of the support, and now you're getting the long trade going up to the resistance. Probably get a couple of red candles coming out of here, and then she's going to go short again because this likes to stay in a range. Look how long it's been in this range. It just likes to stay in this range, and you can just keep on trading it in that range as well. There's 3 ways that we trade, guys. We trade with the trend. The trend is your friend. So euro US dollar, that's a trend. You're trading short. Then we trade in a range. A range is the easiest thing in the world to trade. It stays in that range. It stays between those two prices. And you can just trade out of the support, out of the resistance all the time. And then we counter trade. Now, counter trading is more difficult because what you're waiting for is you're waiting for a price to break its structure. Because in structure, it breaks that structure, heads to the downside, and then you want to go against the trend because it's breaking structure. That's when you go against the trend. The most difficult one to trade is the one going against the trend. The easiest one to trade is the one going with the trend because those always make you money usually. So guys, that's trading on the charts. Let's go and have a look at the maths of trading. So now that you've seen the charts and now that you know on the charts how you can trade and what the best method is to trade, now you need the maths of the trading. Now you need to understand exactly what to do. And it's really simple at the end of the day. The simple maths is this. You need to take an account size. Now let's say your account size is $100,000. That's it. That's your account size. It can be any size, guys. I'm just using this as a round figure. Some guys will attack me and say, but some people can't afford a $100,000 account. Some people have only got a $5,000 account, blah, blah. Yes, it's all the same. At the end of the day, it's all relative because we work in percentage of account. So whether you've got a $10,000 account, a $100,000 account, or $1 million account, it really doesn't matter. So we'll work with a $100,000 account just to make it easy. And let's say you've now got this $100,000 account and you want to trade on it. What you do, the simple maths is this. You trade on every single trade. You trade 1% of that account, which is $1,000. In other words, you work out the risk of every trade at $1,000. So what you do is you go to the trade and you say, where do I think this trade will be invalid and I'll want to get out of this trade? I don't want to be in this trade anymore if it reaches that point. And you work out how much of that is $1,000, and then that's how many points, contracts, pips, whatever it is you're trading, you can take. Whether it be Forex, index, commodities, really doesn't matter. Shares are different because you can work out shares based on the price of the company, etc. So let's keep that aside. I'm talking about here trading with Forex, commodities, indexes, things like that. So now you've got contracts, points, pips, whatever, right? So now you've worked out $1,000 worth of points and you want to take the trade. Make sure that when you take the trade, that your risk to reward looks good. In other words, don't be making less on your win than you're losing because you're paying $1,000 for this trade. If you're paying $1,000 for this trade, try and make $2,000. And if you can't make $2,000, at least $1,500. Try and make more on the win than you're going to lose. Because at the end of the day, the simple maths is this. Out of the 10 trades that you take, the high probability is you will lose 5 and you will win 5. And if you lose and win the same amount, or if you lose and win less than you lose, it's not great. So what you need is a system that helps you to win more on your wins and lose less on your losses. Simple theory, really. So in other words, be prepared to take $1,000 loss on every single trade and try to make more on your wins. Try to make bigger wins at the end of the day. Now, the first part of the business plan is in place. Easy stuff, isn't it, eh? But now you get into the trade and it goes into a win. When it's $300 in profit, don't suddenly decide, hey, it's time for me to get out of the trade now and run off with my profit and be off. No, stay in the trade, guys. Stay in the trade. Don't run. And even if it goes up to where your target profit target is, don't get out of the trade. Take your stop loss and move it into profit behind the profit. And if it goes further, let it go further and keep pushing the stop loss up behind it. When it comes back, it'll take your stop loss out and you'll make some money. When you go about $500 or $600 into profit, move the stop loss up to break even, then the trade no longer costs you any money. Now, the simple policy is this. If it goes into a loss, those fear receptors, don't let them kick in and say, oh no, I must move my stop loss away because I don't want to lose on the trade, because you're just going to make the loss worse. Don't try and dollar cost average down. If you want a dollar cost average, do it up. Buy more when you're winning, not when you're losing. Now, the simple maths of this trade is if you're risking 1% per trade, if you were to lose 10 trades in a row, which is almost near gargantuanly impossible, but if it was to happen, because it can happen, you would lose 10% of your account in total. That's it. And that you can handle. That you can get back. And that you can live with. It's not the end of the world. But if you were to lose 50% of your account, on one trade, that would be a nightmare, wouldn't it? So rather take 10 trades at 1% loss per trade. Make sure that if you're taking a loss, take the loss and walk away, move on to the next trade. It's really important to know this, really important to understand this. Otherwise, you're not going to become profitable in the market. The psychology of it is get over the fear. You know, it's worse to be in a winning trade than it is to be in a losing trade. Because in a losing trade, all traders will try and dollar cost average, they'll try and add to the trade, they'll try and move the stop loss away, and they'll try and stay in the trade for as long as possible. Because they want to be a winner, they don't want to lose that trade. And oddly enough, they won't feel like they're losing because they're still in the trade. So they've still got the ability to win. They call it drawdown. But now you go into a profit, you go into a win, and you see all this green. Most of you, and I can tell you now, most of you will jump out of the trade as soon as you possibly can. You'll go into a win, you'll see the green, you'll click sell, and you'll be gone. You won't run with the profit. You won't go with making more profit. You'll be out of that trade so fast, nobody would have even known you were in the trade. Because you're so desperate to take that profit, or you're so scared to lose that little bit of profit that you've got, that you've actually gained already. There's a profit lying there. You don't want to leave it on the table. You want to get out as quickly as you possibly can. And that's every single one of you. When actually, if you want to be profitable, what you've got to learn to do is get your head around the fact that you're in a profit and you want to stay in the profit. You've got to get your head around the fact that and start treating your wins like you used to treat your losses. In other words, stay in the trade. I want more of this trade. I want to add to this trade. I want to keep this trade for as long as I possibly can because I'm winning. I want it to keep on going. I don't want it to stop now. You see what I'm getting with this? Most of you, when you're going to a loss, you'll keep that trade forever. But when you're going to a win, you'll jump out of the trade before it's even done anything. And then you'll watch it go off to the moon. That's the most painful feeling ever. When you get out of a winning trade too early, that is horrific, guys. That will hurt your mind at the end of the day. But anyway, I'm rambling on now, and I just thought you guys might like to know this. But I hope it's helped you today. I hope this maths of trading, as I call it, will help you psychologically start winning in the market and help you to also start understanding that it's not just about the lines. It's not just about the high probability trades or the systems. It's about your business plan and how you approach the market using a little bit of common sense and maths and logic to make a profit in the market. It's not that difficult, guys. You just have to get your mind around it and understand that it's actually a business at the end of the day. Guys, thanks for watching. Don't forget to watch the last videos. Cheers. Ciao. Bye.